market starting the week on an upbeat note, but we're gearing up for a busy week for both earnings and Fed speak. Well, many see the Fed nailing a soft landing. For that, our next guest says the economy is actually on the path for a slow takeoff. Joining us now is David Royal, Thrivent Chief Financial Officer and Chief Investment Officer. So I've heard soft landing, hard landing, no landing. David, what is a slow takeoff, though? Walk me through that.
Sure. Well, the economy's only had 4 recessions in the last 40 years, so it would be unusual for us to head into a recession say 3 years into an expansion. And so we certainly had some growth pulled forward through the fiscal and monetary policy post-COVID, and we've had to slow that down. You know, we've had 500 basis points or so of rate hikes, and the economy is slowing, but we're at a point in the cycle where I think the economy actually has some good fundamental momentum. Things we're seeing in the private markets, the private equity markets, and so forth, give me some optimism, and as well as what we're seeing in the yield curve, that with longer term rates going up, I think that's actually signaling some fundamental strength in the economy.
I'm curious, David, there are a lot of folks who are pointing to potential areas of weakness. We were hearing a lot about student debt repayment that was coming back online, for example, people's savings being worked down, et cetera. Do you think that those negatives were sort of overhyped, or do you think it's just that they're overwhelmed by some of the more positive impacts?
Yeah, I think there's a natural unwinding going on in the economy. I mean, by most measures, people have drawn down their savings somewhere around August, September, maybe October, the excess savings above the pre-COVID trend. And we've seen some effects of that. People are putting more on their credit cards. We've seen credit card delinquencies go up, nowhere near what we saw in, say, 2007. But the economy consumer is facing some additional stress. But, some of the points of strength, I'd say, is, we have actually $10 trillion more in home equity than we had in early 2019. And there's less than half the home equity loans outstanding. So the consumer still has a pool of assets and equity it can draw going forward.
And Dave, interested to get your take, too, on this geopolitical risk, Israel's war with Hamas, and how you're thinking about that as an investor. We did have Israeli Prime Minister Benjamin Netanyahu, David, today. He's cautioning Iran and Hezbollah not to get involved. He said, saying if they do, the price they pay will be much heavier. We had a guest on earlier, David, who was saying maybe investors are being maybe a bit too complacent with how they're thinking about this conflict. How are you thinking about it?
We're certainly paying close attention, and it's a horrible humanitarian crisis. And our thoughts and prayers are with all the innocent folks involved. But markets tend to recover from geopolitical events fairly quickly, even significant ones. All eyes are on Iran. Whether Iran would get involved, that would certainly escalate. But even major geopolitical events in the past, markets have gone down pretty quickly, but then they've often recovered fairly promptly. One of the exceptions was in the 1970s, of course, with the oil crisis, which put pressure on inflation. And we're in a very different spot now in terms of oil. As you know, domestic production has significantly increased. We're actually net exporters of oil. So we're in a very different position now than we are in the 1970s. And markets' jobs are to assess the long-term economic impacts of geopolitical events. And while we're watching it closely, I would be looking for buying opportunities in the market.
Interesting. In oil specifically?
I think probably in the overall market.
Or in general when it comes to stocks? Mm-hmm.
Areas that we find, I think, attractive in this market. If I'm right, and we are going through the slow takeoff, and we're going to avoid a recession in 2024, you'd want to be in some of the more cyclical names. And one area that I think is attractive is small caps. They're historically undervalued compared to large caps. They have more leverage than large cap companies for the most part, which means they would do well in a strengthening economy. And so looking at small caps, I'd probably look to be, if I was going to add another point of equity, that's probably where I would add it right now, is in small caps.
And David, I know you're watching the housing market closely as well, and home builders is one of the areas I believe you're interested in. The housing market is sort of so fraught right now with mortgage rates pushing higher, but prices not really coming down very much in order to make things more affordable. Where do home builders fit into that picture for you?
Yeah, so the market's really tight because supply of existing homes is diminished because with interest rates so high, if you have a 3 or 4% mortgage, you're not going to put your home on the market. So the supply of existing homes has decreased dramatically. And that's even a situation where we have had significant household formation that we haven't kept up with. And that really goes back to the financial crisis. There wasn't as much home construction after the financial crisis. And then, of course, during COVID, it slowed down. So right now, the greatest percentage of homes being bought are actually new construction because you're not getting those existing homes to come to the market. And so I think that presents an opportunity for home builders. They ran hard earlier this year, and they've since come down, depending on the home builder, 20, 25% from their peaks. So I think they're attractive on a secular multi-year basis.
David Royal, thanks so much. Appreciate it.
Thanks for having me.